Housing affordability sucks and rent is at an all-time high. Using a low down payment loan will bankrupt you or set you free depending on this one thing. Chances are that you've heard some crusty commission-hungry real estate agent say something cheeky like you should marry the house and date the rate. That is terrible financial advice. My wife and I were one of the unfortunate couples that had a 2.25% interest rate on a home that we then had to sell. My wife's a Navy psychologist, and we got orders to move from Pensacola back here to San Diego. So not only were we giving up a 2.2% rate, but you can't get houses in San Diego for Pensacola, Florida money. We bought our house in San Diego when rates were pretty much at an all-time high. On top of that, I'm self-employed and income and tax returns and everything get a little bit funky. We were also in a jumbo loan, so we ended up locking a 7.5% interest rate. Ugh. Now, fast forward about a year and a half, we were able to refinance into a lower VA rate at just 6.25%, which sounds incredible. My payment in theory would have decreased by something like 20%. Here's the problem though. You remember those fires up in LA? Well, our insurance went up and offset a lot of that delta. So realistically, at like 1.25% lower, my mortgage is only like $800 a month less. Even if rates went down by another full percent, you're looking at roughly 10 to 11% in cheaper monthly costs to you. Chances are, if you're struggling to afford a property right now, it being 10% cheaper a month might not make it super like comfortable and affordable. In order to see like real benefit in a refi, rates would have to decrease substantially. And quite frankly, I think the days of 2% are long behind us. My gut is that we're going to end up somewhere in the mid 5s long term. If you use a low down payment loan like an FHA or a USDA or some sort of like a local grant program, you are playing with fire if you are paying retail for a property. Now look, I get it. My wife and I's first house was $75,000 in a not so great part of Indianapolis, and we used a 3.5% FHA down loan. And it took pretty much every dollar we had to get that place closed. And even back then, there were times that it was like, how am I going to make the ends meet on this thing? So I realized with rent being at an all-time high and properties not being affordable to purchase, you're probably kind of between a rock and a hard place. But let me give you a little bit of a reason why you shouldn't just bite the bullet and pull the trigger. When you go to sell a home, you are going to have somewhere between 8 to 10% in selling costs to get out of that property. We all know with new cars, if you buy something new and drive off the lot, it's immediately worth less money. But real estate is no different. When you buy a home, you're paying origination fees that are typically a couple percentage points of the value of that home. A point is basically 1%. When you go to sell a house, you're going to have somewhere between 4 to 6% in real estate agent commissions. You're also going to have 1 to 2% in closing costs, and that doesn't take into account any repairs or upgrades or maintenance that you have to do on the home. So if we have 4 to 6% in agent commissions to get out of the place, 1 to 2 percentage points in closing costs, not to mention the origination fees you paid at closing, not counting on if a buyer asks you for any credits or anything, you're looking at roughly 8 to 10% the cost of that home to get out of it. Spoiler alert, if you can't sell a house and you can't afford the payments on it, your option is bankruptcy or deed in lieu of foreclosure. So if we pay market value or even slightly above market value for a property and only put 3% down, we're pretty much starting out upside down by 7 to 10%. When you buy a home, there's something called an amortization schedule, which is what percentage of your payment goes towards the principal versus the interest. The problem when you first buy a property is that amortization schedule is front loaded with interest. So for your first couple years, you're not really paying the property down, you're pretty much just paying the bank. Conservatively, you'd be looking at 5 to 7 years of on-term payments to recoup that 7 to 10% that you're upside down. Now, you might be living under a rock, but the news doesn't really make it seem like real estate is just going to explode in value and continue to just go up and up and up and up. So if prices go down, you're even more screwed. I personally believe that owning a home has fundamentally changed or shifted. You don't have to buy a house on market, nor do you have to pay somebody's asking price. In fact, I would go so far as to say that if you're currently buying, you should be making some pretty insultingly low offers or looking for properties that are off market to get a better, safer deal for you and for your family. I've personally flipped hundreds of houses over the years, and I've also helped real estate investors and families go off market for their own properties. In a nutshell, it's kind of like trading in a car. You can drive it over to CarMax or your local dealership. They're probably going to offer you a little bit less than what you want, but it's more convenient than having to sell it yourself. Buying or selling property is no different. You can find a real estate agent to navigate and handle everything for you and pay them a premium. You can also not hire a real estate agent, reach out directly to property owners and simply ask them if they would be willing or open to selling. One of my own employees literally walked up to a garage sale and said, "Hey, I'm curious, are you guys selling the house once everything is cleared out? I'd really like to have my kids in this school district." He ended up buying that home for substantially below what fair market, if we're calling it fair right now, value is. So the first thing we want to do is not go pay retail for something on market with a low down payment loan. You should be looking for a 10, 15, or even 20% discount. That gives you a lot of cushion. It also makes it that if you don't like living there a year later, you can turn around and list it for fair market value and potentially even turn a profit. For instance, does the property maybe have like a detached outbuilding that you don't need? Maybe you could lease that out as a shop, offsetting your monthly costs on the property. I'm not going to sit here and feign like false modesty. I told you my mortgage went down by 10%. If you can do basic math, my mortgage is like $8,000, but that doesn't tell the whole story. On the other side of this wall, we have an ADU, which is known as an accessory dwelling unit. I have a full separate apartment that we can rent out to offset our housing costs. On top of that, I'm on some acreage and we are starting the process of building a second unit to help us do so even more. A more common setup, if you're not in an expensive or coastal market, is like if you have a finished walkout basement, can you separate that and lease that section out? One of my biggest regrets back in the Indianapolis days when I was struggling with that $75,000 mortgage is that I didn't just buy a duplex. You can use that same low down payment loan, but live in one side, lease out the other side to offset some of your costs. One of the other changes that we're seeing with real estate is what I'm calling like coastal gentrification, but it might not even be the coasts. I've long held the hypothesis that real estate is going to get cheaper in the Midwest. Guys, I grew up in St. Louis. I lived in Indianapolis. I would way rather live in San Diego, but it is way more affordable back in the Midwest. Affordability sucks less in the Midwest, but living there sucks a bit more. When we moved to Indianapolis, we couldn't afford what we wanted, which was like your brick McMansion-y, your normal subdivision, 3-bedroom, 2.5 bath, 2-car garage in a great school district. We had to live more downtown in an area that wasn't quite so great, and we had to put some sweat equity into the property. If I'm in your shoes, I would be not paying retail, looking to offset my monthly costs in any creative way that I could. I would also want to be intimately aware of the fact that when rates start to decline, I don't think properties are going to get cheaper. Don't marry a house. Get the absolute best deal that you can. Do anything you can think of creatively to offset your monthly costs, including roommates or renting out space you're not using, and lock in the best rate that you can and refi if or when it gets better. There is nothing that sucks worse than being house poor. Even if it's a $75,000 house that you really can't afford in Indianapolis, like what we had, make sure that you're setting yourself up for success and not for failure. Thank you guys for taking the time to hang out with me today. If we haven't met, again, my name is Ryan Dossey. Be sure to like this video so it gets in front of more people like you. If you guys have any questions about how to buy a property off market, that's what this whole channel is for. And if you haven't already, subscribe. I'll talk to you guys next time.